Have you ever wondered, why do so many people reach retirement age and still struggle with money, while a few keep growing their wealth even into their 60s and 70s? Is their secret simply picking the right hot stocks, or are they just incredibly lucky? The truth is far more straightforward, and very few people dare to follow it. Picture this. You're 60 years old with a lifetime of savings. A financial advisor tells you to load up on bonds for safety, buy index funds for diversification, and choose high-dividend stocks to receive steady quarterly income. Sounds reasonable. And yet, Warren Buffett, at 94 years old, still one of the greatest investors of all time, does the opposite. He doesn't choose bonds. He doesn't choose broad index funds, and he doesn't even focus on high-dividend stocks. So why would the Oracle of Omaha turn his back on what the market considers the safest, most conventional options for older investors? What does he know that most people completely miss? In this video, we will explain why Buffett avoids these three common types of investments and the radically different strategy he uses to keep multiplying his wealth after 60. Are you ready to look at money from an entirely new perspective? If you are, comment below, "I want to know Buffett's secret," and let's dive in. 1. Long-term bonds, a safe haven that quietly drains your wealth. Picture someone about to retire. After decades of hard work, it feels like the right time to play it safe. Put most of your life savings into 20 to 30-year treasury bonds. Why? Because every financial expert says government bonds are the safest shelter, low risk. Just sit back, collect interest, and enjoy your golden years. Sounds perfectly reasonable, but Warren Buffett, at 94 years old, calls this a sweet trap. In one of his Berkshire Hathaway shareholder letters, he said bluntly, "Bonds are not the place to be these days." Why is Buffett so strongly against them? The root of the problem lies in one deceptively small but dangerous word: inflation. The inflation trap. When you buy a 30-year treasury bond with a fixed yield, say 3% per year, you are essentially locking up your money for 3 decades to earn that 3%. You're betting that during those 30 years, inflation will never rise above 3%. But history has repeatedly proven the opposite. Think back to the 1970s, when inflation in the US averaged over 6% yearly, with some years hitting double digits. Even recently, in 2022, inflation spiked above 9%. During times like these, while your bond faithfully pays 3% interest, the real value of your money is eroding day after day. A real-life example. Take my acquaintance, Mr. Min. In 2000, he invested $100,000 in 30-year bonds paying 6%. He thought, 6% a year? Perfect. Much better than a bank deposit. 20 years later, he's still getting his interest payments on schedule. But when he looks around, he realizes that $100,000 today buys only what $60,000 could have repurchased then. Almost 40% of his purchasing power has evaporated. On paper, it looks safe. In reality, it's a silent loss. You don't lose your principal on paper, but inflation is slicing away at your money year after year. Buffett's view: safety isn't enough. You need growth. Buffett sees things very clearly. After 60, your biggest enemy is not market volatility, the loss of purchasing power. Strange but true. When you're 30 or 40, a few bad years in the market don't matter because you have decades for your portfolio to recover. But after 60, losing purchasing power means you may retire today only to struggle 10 to 20 years later, even if your account balance looks the same. Buffett prefers to invest in businesses with pricing power, companies that can raise prices and customers still have to buy. For example, Coca-Cola. In 1988, a can cost 50 cents. Today, it's over $1.70. Companies like these not only withstand inflation, but also increase their wealth often. While long-term bonds only promise a fixed return, businesses with pricing power allow you to benefit from rising prices instead of being hurt by them. The common misconception: bonds, chances safety. Long-term bonds give you the illusion of safety, not absolute protection. That piece of paper that says 3% fixed makes you feel secure, but the cost is 30 years of silent erosion from inflation. Buffett often warns, the most dangerous thing is when you think you're safe. Buffett's lesson: after 60, don't lock up your money in long-term bonds just for the feeling of stability. Absolute safety comes from owning assets that grow faster than inflation, solid companies with durable competitive advantages. In other words, Buffett avoids long-term bonds not because he likes risk, but because he understands that what most people call safe is the most significant risk of all in retirement. 2. Broad index funds, when average is no longer safe after 60. Almost everyone who starts learning about investing hears this advice. Don't bother picking individual stocks. Put your money into an S&P 500 index fund, hold it long-term, and you'll be rich. And for most young people who don't want to spend time studying the market, that's a perfectly reasonable strategy. But once you cross 60, Warren Buffett does the opposite. He doesn't buy broad index funds for himself. Why? The key factor: time. Take a closer look at how index funds work. When you're young, 30 or 40, time is your greatest weapon. Even if the market drops 30 to 40% for a few years, you still have decades to recover and let compounding work its magic. But at 60 or 65, you no longer have 20 to 30 years to wait for the market to bounce back. A clear example: from 2000 to 2009, the S&P 500 had a lost decade, with almost zero growth over 10 years. If you retired in 2000 and were living off withdrawals from an index fund for that entire decade, you would have been forced to spend down your principal while your portfolio wasn't growing. What Buffett tells others versus what he does himself. This is where many people misunderstand him. Buffett often tells the average person, if you don't have time to study, just buy an index fund. But that's advice for the majority, not what he does with his money. Berkshire Hathaway's portfolio, Buffett's company, has never looked like an index fund. It's highly concentrated. Just 5 companies account for roughly 75% of the portfolio's value. Apple alone makes up over 40%. Why Buffett avoids broad index funds. After 60, because index funds equal average. When you're young, an average result is good enough. But after 60, average means trading your limited remaining time for mediocre returns. Instead, Buffett places big bets on several exceptional companies rather than spreading money across 500 average ones. That's how Apple, Coca-Cola, and American Express helped him outperform the market by a wide margin. For example, Apple, which Buffett started buying heavily in 2016, has risen over 400% since then. During the same period, the S&P 500 has gained only about 100%. His results would have been at least 4 times worse if he had bought an index fund. Focus. Instead of over-diversifying. One of Buffett's most famous quotes is, "Diversification is protection against ignorance." At 60 plus, instead of spreading investments to reduce risk, Buffett focuses on a few companies he knows inside and out. Businesses with stable income and durable competitive advantages. These products can raise prices, and customers will still need them. Leaders who can reinvest profits at high returns. The lesson: index funds are a safe average for young, inexperienced investors. After 60, you don't have time to wait for average. You need outperformance from quality assets. Buffett knows that after 60, broad index investing might look safe on paper. Still, it's dangerous in reality because average returns often aren't strong enough to protect your purchasing power and maintain your lifestyle for 20 to 30 years of retirement. 3. High-dividend stocks. The safe income trap after 60. Among all the popular pieces of advice given to people approaching retirement, perhaps the most common is buy high-dividend stocks, sit back and enjoy regular quarterly payments, safe and stress-free. On the surface, that sounds perfectly logical. Who wouldn't enjoy receiving money in their account every few months without ever selling their shares? However, Warren Buffett, famous for his long-term investment mindset, avoids this stock group, especially after 60. Why? The psychological trap of regular dividends. Dividends create an illusion of safety. Every quarter you receive cash and feel like you're making a profit. However, Buffett points out that this is only a feeling, not necessarily the best strategy. Here's what happens when a company pays a 4% annual dividend. That dividend is immediately taxed as ordinary income, typically 15% to 20% or more. After tax, your net return drops to about 3.2%. Many investors then use that money to buy more shares, which puts them right back where they started, only now with part of their return lost to taxes. By contrast, if the company keeps those profits and reinvests them, your gains compound without any taxes being triggered until you sell the stock. This is the kind of untouched compounding Buffett loves. Proof from Berkshire Hathaway. Buffett's company, Berkshire Hathaway, hasn't paid dividends since 1967. If you had invested $10,000 in Berkshire back then, it would be worth more than $300 million today without a single dividend payment. Instead of distributing cash, all earnings are reinvested and continue to grow inside the business. The two biggest problems with high dividends: taxes and performance. Taxes. Every time you receive a dividend, you owe tax immediately. That portion of your money loses the chance to compound over decades. Performance. Many companies pay high dividends simply because they have no better ideas for reinvesting their profits. They've run out of opportunities for high-return projects, so they hand out cash. Buffett doesn't like investing in such companies. He looks for businesses that can generate 10% to 15% returns on retained earnings, far higher than the 3% to 4% before tax from dividends. Example: Apple, growing through retained earnings. Apple pays a small dividend, around 0.5% per year, but Buffett loves its share buyback policy. When Apple spends hundreds of billions of dollars to repurchase its shares, the total number of shares outstanding goes down. This automatically increases Buffett's ownership stake in the company, without him spending another dime and without any yearly tax liability. It's like a hidden dividend, but much smarter. He has no cash outflow or immediate tax, and his company's share grows. Buffett's core lessons. Don't confuse income with wealth growth. A steady dividend doesn't necessarily make you richer. It can slowly drain your wealth out of the business. Prioritize companies that can reinvest profits and grow internally instead of those that pay out cash. Buffett suggests selling a small portion of appreciated shares when you need cash. This way, you only pay tax on the capital gains, and capital gains tax rates are usually lower than income tax rates. Looking at Warren Buffett's portfolio after the zero, you'll notice an apparent shift. Gone are the long-term bonds, the broad index funds, and the high-dividend stocks. It's not that Buffett doesn't like these investment vehicles, it's because he understands their fundamental weaknesses and refuses to let a lifetime of wealth fall into traps that only look safe on the surface. The three most significant reasons why Buffett avoids these assets can be summed up as follows. 1. The silent killer, inflation. Buffett often says the biggest risk in investing isn't price volatility, it's the erosion of your purchasing power over time. Long-term bonds. Fixed yields may sound safe, but they are sitting ducks for inflation. When you lock in 3 to 4% returns for 20 to 30 years, even a modest 5 to 6% inflation rate guarantees a loss in real terms. Example: 30 years ago, many investors bought bonds at 8%, thinking they had a great deal. When those bonds matured, the money they got back could only buy about 60% of what it used to. Inflation is not a theory for someone over 60, who may live another 25 to 30 years. It's a real enemy. 2. Average is no longer enough when time runs short. In your 30s or 40s, a diversified index fund portfolio that averages 8 to 10% per year is a perfectly safe strategy. Over decades, the power of compounding turns those average returns into a significant number. But after 60, you no longer have 30 years for average to work in your favor. Buffett understands that. The market can go through long, flat, or negative decades. For example, 2000 to 2009. If that flat period hits right after you retire and you must start withdrawing, your portfolio shrinks and may not recover in time. Buffett concentrates on only the best companies instead of spreading money across 500 stocks like an index fund. The tax drag and inefficiency of high dividends. It may sound counterintuitive, but high-dividend stocks are far from ideal. Every time you receive a dividend, you owe tax immediately, slowing down the compounding effect. Many companies that pay high dividends do so because they have no better opportunities to reinvest their profits, which often signals lower growth potential. Buffett prefers companies that keep the profits inside and reinvest them at high rates of return rather than distributing cash and reducing the compounding power. 4. Playing defense instead of offense. The common thread among these three types of investments is a don't lose mindset. Long-term bonds, fixed returns, but a guaranteed risk of losing purchasing power. Broad index funds, diversification to reduce volatility, but settle for average. High-dividend stocks, a feeling of safety, but often at the cost of long-term growth potential. Buffett believes that after 60, if you only play defense, you eliminate your chances of winning. With life expectancy increasing, a 60-year-old may still live 20 to 30 more years. If those decades are spent merely preserving capital, you will lose to the slow but relentless erosion of money's value. Buffett's mindset. Buffett does not pursue safety through passivity. He manages risk by owning strong businesses, companies that can raise prices faster than inflation and keep his capital working year after year. He understands that short-term volatility is far less dangerous than the slow death of purchasing power over the long term. Conclusion. Avoiding these three types of investments has nothing to do with Buffett being a risk-taker. It's because he understands what accurate safety means. And that's why, in the next part, we'll look at the alternative strategy Buffett uses after 60 to both protect and grow his wealth. Warren Buffett chose a different path after stepping away from the three types of investments most retirees are advised to follow: long-term bonds, broad index funds, and high-dividend stocks. Interestingly, he didn't choose to take on more risk. He decided to invest more intelligently, optimizing every dollar to preserve purchasing power and keep his wealth growing for the rest of his life. Here are the three key strategies he has applied since turning 60. 1. Replacing bonds with businesses that have rising power. Buffett realized that only strong businesses can protect your money in an inflationary world. Instead of locking money into bonds earning 3% to 4% a year, he invests in companies that can raise prices without losing customers. Examples: Coca-Cola. In 1988, a can of Coke cost just 50 cents. It's $1.50 to $1.75 today, and sales are still growing. Apple. The company raises iPhone prices every few years, yet sales keep hitting record highs. This creates a natural hedge against inflation. As prices rise, the profits of these companies rise too, which in turn increases the value of their stocks. Comment: most people overlook this. They see the apparent safety of bonds and forget that the danger is the slow erosion of purchasing power over time. 2. Focus on quality, not over-diversification. A broad portfolio of 500 stocks, index funds, can be effective when you're young. But after 60, Buffett shifts his mindset. You don't need to own every company. You only need to own the best and know them well. Berkshire Hathaway's current portfolio holds only 10 to 15 prominent positions. Just 5 companies account for 75% of its total value, and Apple alone is over 40%. Why? With vast capital and less time ahead, Buffett cannot afford to settle for average returns. He puts his money in dominant companies with substantial competitive advantages and lets them do the work. Examples: American Express, a brand so strong that customers stay for decades. Moody's virtually controls the credit rating industry. This is the opposite of the read-out-to-stay-safe approach. After 60, spreading too thin waters down performance. 3. Prioritizing total return over dividend income. Buffett doesn't care much about high dividends. Instead, he prefers companies that reinvest profits, allowing wealth to compound without triggering taxes prematurely. This approach has 2 significant advantages: maximized compounding. Profits remain within the company and continue to generate returns. Tax efficiency. He only sells shares and pays capital gains tax when he needs cash. Apple is the clearest example. Apple uses profits to repurchase shares instead of paying a 4% annual dividend, forcing investors to pay tax. As a result, Buffett's ownership percentage in Apple increases every year, at no extra cost and with no immediate taxes. He calls this a compounding machine with no leaks. Overall mindset: smart offense, not extreme defense. The common thread across these 3 strategies is avoiding false walls of safety, concentrating on the highest quality assets, optimizing taxes and time so that money works for decades after retirement. At 94, Buffett still has over 90% of his wealth in stocks. That might sound risky, but if you look closer, it's a smart risk instead of a guaranteed loss of purchasing power. Key lesson: after 60, investing isn't just about preserving money. It's about growing wealth to live well for 20 to 30 years. Ask yourself this: is your portfolio playing pure defense, or is it being smart like Buffett's? And after hearing all this, you may realize something important. It's not about how old you are. It's about how you think about money. When they reach their 60s or 70s, most people slam the brakes on their financial journey. They follow the same old advice: load up on bonds for safety, buy index funds for peace of mind, and chase dividends to see cash flow into their account. They believe it's time to play defense, but Buffett sees it differently. He understands that life after 60 is not the end of the game. It's the beginning of a new phase that could last another 20 to 30 years. And if you choose the wrong strategy, those decades are long enough for inflation and false safety to erode your wealth quietly. Buffett's message couldn't be clearer. Proper safety doesn't come from avoiding risk. Proper safety comes from letting your money grow smartly while you control the risk. He invests in strong, resilient businesses that raise prices and grow profits for decades. He chooses to keep his money working instead of letting it sit idle and lose value. So now the question is, will you keep following the beaten path? Or will you dare to think like Buffett, looking 10, 20 years ahead and choosing a more sustainable path? If this lesson has made you rethink your approach, Leave a comment. I will rethink my strategy after 60. And don't forget to like and share this video with someone you care about, because one right decision today could change your entire financial future.